What's up, everybody? We have a few things to talk about today. First of all, UNH was up almost 10% yesterday, and over the past month, up 36%. They have really surged off their low. Of course, this is nothing compared to where the stock has been. But we're going to talk about the news from yesterday. We're going to see, why did the stock jump? Is it justified? How does the risk reward look today for UNH stock? We're also going to talk for a moment about Lyft. If you follow the channel, you know that this is a significant holding for me. Lyft is up over 40% in the past month. This is quite a significant surge. So we're going to retake a look at Lyft. And then finally, we're going to look at some comments on my recent Lululemon video. Obviously, Lululemon is not a stock that has been surging. I recently posted a video saying I bought a very small position, just under $168 per share. So we'll take a peek at a few of those comments and I'll give you my thoughts. As always, if you get value out of the video, subscribe to the channel. We just passed 3,500 subscribers, so thank you so much to everyone who has followed. Now, let's dive into UNH. I've made videos on UNH before. Over the past month and a half, I've basically been saying that all of these major health insurance companies are significantly undervalued. Taking a look at our spreadsheet here, I am using my own custom Google Sheet extension to make these sheets. Hopefully, Google will approve this soon to be in their little add-on marketplace, so everyone will be able to get this add-on, get this extension, and make sheets like this. Trust me, as soon as this is approved by Google, I will let you all know, and then hopefully you can play around with this yourself. Very simple. You just put UNH in here, and then we would hit load, and now my sheet is going to load a bunch of data. We see the price chart of UNH, where this little jump that we've had recently, yes, we're up about 36%, but look, it is just a blip on the chart. We took this very quick little dip down into, about the 240 range or so, and then this recovery is just that little tiny bit at the end. So what's this news? What's the update? Why was UNH up, almost 10% yesterday? Here's the story. UNH sees 78% of members in high-rated Medicare plans. Here's what this means. I'm sure that this is probably a bit foreign to you if you don't live in the US, but Medicare is a government program. It is for older people, typically 65 and older, and these star ratings, the ratings of these Medicare Advantage plans, are pretty much a measure of quality of care. They're measured from 1 to 5 stars, 5 being excellent, 1 being just completely awful. There really aren't plans that are 1-star plans. Pretty much anything that is below 4 stars is seen as, kind of just baseline care. You might have fewer supplemental benefits like, dental care, vision, stuff like that. You're probably going to have a bit of a higher copay or premium as compared to, the 4-star and up plans are what you think of as a more quality plan. However, the biggest consideration here is that if you have a plan that is 4 stars or higher, then you get a bonus payment from the government for those plans. UNH, as the provider here, they get a 5% bonus payment for a 4-star plan or higher. And you might think, 5%, that really doesn't sound like much. Keep in mind, the operating margin of these companies is very thin. UNH historically has had, about 8% operating margins, but their margin on Medicare is even less. Operating margins of 6% in Medicare certainly would not be unusual. And if you think about what that means for a 5% bonus payment, if you are making 6% operating margins and you are getting a 5% bonus payment on, say 80% of your book, 80% of your plans, if that goes away, your margins get crushed. And typically, UNH has had, about high 70s, about 80%-ish of their Medicare Advantage plans getting 4 stars or higher. This past year, it hasn't been that great. There's definitely been a dip. But this news that they're going to go back to, high 70% of these plans, 4 stars or higher, lends credence to the story that, yes, 2025 is going to be a bad year, but the future for this company is going to pretty much look like the past. They might not necessarily recover to 8% operating margin next year, but the future for this company, they're going to reprice their plans. Demand for healthcare is going to go up. I think recovery is inevitable. And I think in a few years, we're going to look back in 2025 and just say, man, that was the time to buy pretty much all of these health insurance companies. The only other real news here yesterday from UNH is they came out and reaffirmed their guidance for the year, which wasn't great guidance. I mean, they're saying $16 in adjusted earnings per share. They've been cutting that number down pretty much all year long. I mean, last year, people thought that they were going to be in the mid-20s in adjusted earnings per share for this year, and now we're down to 16. To be honest, to me, a lot of this news seems really like a nothing burger. I mean, yeah, they reaffirmed their guidance. That's to be expected. The star ratings, yeah, that's good, but honestly, also to be expected, I think. As far as what this means for our forecast for the future, for me, nothing has really changed. I'm going to keep the numbers the same as I had them before. These are all zeroed out because we're just looking at the nice new Deep Value Hunter stock valuation template here. But I think base case earnings growth, high single digits, operating margin, I'm not even going to assume that they get back to 8%. I'm just going to assume a 7% operating margin. Free cash flow margin, I'm going to assume that it's going to be low for the next couple years and then somewhat recover. And I'm just going to give them a 12 times multiple. And if these assumptions come true, you are looking at a double on the stock, 15% annualized return over 5 years. Whoops, I meant to actually change this price change field here. The way that my template used to show data is I show an IRR. This is how much we expect to return every year over 5 years if our assumptions here come true. The fair value today is basically what price do we think is a fair price for the stock for a 10% annualized return. I can talk more about the methodology and philosophy here in a future video, but I don't want to go too into the weeds here. The price change I always had representing the difference in the price today versus our fair value today price. But I actually think a more useful number is to think about just the price change over 5 years. And that is what I'm doing in my new template. So I'm just going to update that here. And we see, as I said, over 5 years, you're looking at about a double on the stock in this scenario. And this isn't even us forecasting a full recovery. We're only assuming 7% operating margins. They've typically been around 8. We're only assuming 8% revenue growth on the top line. Historically, they've been more like 10. And I've only given them a 12 times multiple. Again, historically, this would be a very low multiple for the company. So I think with rather conservative assumptions, UNH, it still looks pretty good today. If you want to see me dive into the bear and bull case, you can go check out some of my past videos on UNH. Again, I own the stock. This isn't a recommendation for anyone else to buy UNH. I'm just giving you my opinion. And for me, I like it. I'm certainly not going to sell my shares. I'm doing nothing here. Now, let's talk really briefly about Lyft. Lyft is up about 40% in the past month. And what has been the news? Why is Lyft up so much here? Well, the news is essentially nothing. When they reported earnings in the beginning of August, actually, the stock was down about 10% pre-market on their earnings. I talked about it here on the channel. I said, I think Lyft is offering excellent risk reward. The earnings were pretty much in line with what management was telling us. See, last time we updated our Lyft sheet here, it was August 7th, right after earnings. In fact, let's use our new template, show you how it would work if you got this thing. You just put in Lyft in here and hit load. And I'm going to delete these assumptions that we had for UNH, reset all those to 0. Obviously, Lyft has not been a public company forever, so some of these values don't show up. Just going to hide these rows here, make our charts look a little bit more clean. One thing we can tell from just looking at these graphs is Lyft is just flipping into profitability. This is something we've talked about in this company, is when you're just flipping into profitability, it can make ratios like, say, the PE ratio. We're looking at a PE ratio of 84 here. Lyft looks absurdly expensive. But why is that? It's because the E is just this little tiny sliver. So of course, P to E is going to be a massive number. The question is, where are margins going to end up for this company? If you end up with 10% margins on a company like this, then Lyft is not really looking very expensive. I mean, even today, just looking at them on a cash flow basis, this is a company that right now has an adjusted free cash flow yield of 7.5%. And in case you're wondering what my adjustment is that I make, I always subtract out share-based compensation. This is a real expense to us. If you were just looking at their reported free cash flow yield, it would look like it is in the double digits right now. But the way I calculate it, where I'm subtracting out all that share-based compensation, I'm still seeing 7.5% free cash flow yield for Lyft, which I think is a decent quality company. It is growing, margins are improving, and my bull case for this company was basically just management's long-term guidance. I'm just taking their guidance as the bull scenario. They might even outperform. Lyft has outperformed their guidance in the past a number of times. But if I give them their guidance, 14% growth on the top line, I'm going to give them operating margins of 9%, free cash flow margin 7%. I don't think that these are demanding numbers. I think the company can hit this. And then if I give them a 20 times multiple, which I think is probably fair in our bull scenario for a company that is growing double digits on the top line, you're looking at a 28% annualized return on Lyft. That is between a 3 and a 4x on your money. Or if you think about that as a price change from today, that is about a 250% increase from today's price. Now, if you want to hear a deep dive about this, you can search Lyft Deep Value Hunter. I'm sure you will find my videos going into the company. But the reason I wanted to talk about this today is just to talk about what do we do when a stock goes up 40% that we hold and it's really on nothing. There is no news here. The price is just significantly higher than it was a month ago. That's the only change here. For me, whenever the price of a company that I own goes significantly up or significantly down in a short period of time, I just try to take a step back and re-examine my thesis. Do I still like it? Do I think it offers good risk reward? Do I like it more? Do I like it less? Sometimes if a stock goes up a lot for no reason, you look and you decide, you know what? I don't actually think the risk reward is amazing today. I'm going to take some profits. Regardless of your opinion on Lyft, whether you like the company, whether you don't, I think we can all agree the risk reward today for Lyft is simply not as good as it was a month ago. With that said, when I look at my thesis, when I look at my sheet, when I think about what I expect for Lyft going forward in the future, I think the risk reward is still decent. I'm not going to add to my position at these prices. A lot of you know I thought Lyft was a very clear buy earlier. I'm just going to do my favorite thing, which is to do nothing. I'm going to hold my shares. I'm happy to hold it, but I'm not adding to Lyft at these prices. I think there's more attractive opportunities. And with that, let's move into Lululemon, which I know is a very controversial stock. People have lots of different opinions here. While we do that, let's just put Lulu in on our sheet and hit load. And I'm just going to zero out these numbers that we put in for Lyft. Okay, now, as I said, I posted a video on Lululemon. I bought in just under $168 a share. And obviously, a lot of comments have a lot of different opinions. I just want to talk about a few of them here. Charlie says it's risky to buy this stock now. So yes, I agree. Buying individual stocks is risky. But I think this feeling that it's particularly risky right now after the stock has dropped to buy Lululemon, I think this is a bit of an illusion. The fact of the matter is Lululemon was way riskier at $400 a share than it is today at $165. You maybe didn't feel that risk in your gut because if you look at a chart and it just looks like this and it goes up and to the right, and yeah, of course there's volatility, it's an individual stock, but pretty much investors in Lululemon have just been really happy. You don't feel the risk. A stock chart only tells you the history of the company. We're interested in the future. The chart can only tell you so much. Whenever we're looking for value companies, especially deep value companies, a lot of times you're looking at companies where there's a problem. There's a reason the stock has sold off so much. Do you think UNH is more risky today at 340 or when I was talking about it in the 200s? Or do you think it was more risky when it was trading about $600 a share? I think you know what my answer is. But if you look at comments on videos, everyone feels that UNH is risky when it's in the 300s. Everyone is talking about the risk. And yes, there is always risk, but people don't feel or talk about the risk so much when a stock is trading at all-time highs. It's at $600 a share. Let me tell you, buying UNH at $600 a share, significantly riskier, in my opinion, than buying UNH at $300 a share. So I understand the sentiment. Buying a stock when it's down, it feels risky. Let me tell you, there is always significant risk in buying individual stocks. Now, speaking of buying a stock when it's down, this investor says it shows you don't know how to trade. Now you're just going to be holding it for a long time before it moves back versus waiting for a breakout. Okay, this one might be more a difference in philosophy or investment style. Some people put a massive amount of weight into technical analysis and looking for breakouts. And I'm not going to say that they're wrong. I think that there is something that we can learn and take away from anyone's strategy who's been successful. But for me, I accept that I cannot time the bottom of a stock. I do not try to. I just try to examine the risk reward that we are offered today on any given stock. If I pick the exact bottom, if I bought right towards the bottom of a stock, it is only through pure luck. For example, these health insurance companies, Centene, UNH, I was making videos saying I was buying and it looks like maybe it was the bottom. I don't know. Maybe these stocks will take another dive and they'll go even lower. I was buying them because I thought they offered great value. Maybe I bought at the bottom. I'm not sure. But if I waited till I saw a breakout in UNH, I think I would have missed this, over 30% run we've had in the past month. The only way you can consistently wait for the breakout and get it right is if you're looking back at a chart with hindsight. UNH at $460 in the beginning of the year was already down more than 20%. If you thought that was a good point to buy and you waited for this breakout right here, guess what? You would be down another 30% on your position. Maybe you thought this was a breakout, or maybe this was the breakout. You can only clearly identify the breakout in hindsight. There's a reason why value investors like Warren Buffett don't put a lot of emphasis on technical analysis in their investment strategy. It's just not nearly as consistent as looking at the future of the company and asking yourself, do we think it offers good risk reward today? Now, there were a decent number of comments of people talking about the product and the brand. Some people were very positive. Jason says, a guy, owns 7 Lulu items, pants, shorts, jackets. My wife owns a few items too. I love them. I think it's decent value. Then there was the flip side of this. Ricardo says, Lululemon, clearly a company that's gone out of fashion, cannot enter Europe, declining in the US and growing in a market where to maintain growth, its margin will have to fall. I think he's referring to China with that market. Train with Raheem says, horrible move. Respectfully, Lulu is dead money. Once a fashion brand loses their cool factor, their pricing power goes down with it. Nobody finds Lululemon trendy in 2025. They cannot charge a premium for their yoga pants and shorts anymore. I feel like this is honestly the beginning of the end for them. So I appreciate comments like this. I want to hear from people who have the opposite thesis to me on a stock. Now, of course, we have a different opinion here. The revenue of this company has more than tripled in 5 years. Yes, growth is slowing now or, just stopping in the case of the US, but some of that I think is almost to be expected after just the massive growth that we've seen in the past few years. Margins remain strong, return on invested capital remains strong. I don't see a dying brand here, but the truth is I don't know who's going to be right. Raheem and Ricardo, they might be completely correct. I should respect their opinions. I should take their opinions into account when I make a bear case for this company. And that brings me to the last comment we're going to talk about today, where Walter said, your bear case is way too bearish. I disagree, and I think this one is a difference in philosophy. Obviously, I bought the stock. I have a good opinion about it. I think it offers decent risk reward. But when I'm making my bear case, I need to think through the eyes of Raheem and Ricardo. What if I am simply wrong? I don't want to go broke. What would that scenario look like? And the numbers I put in for that scenario are no revenue growth at all over 5 years. Operating margins shrink to basically their lowest level, 18%. Free cash flow margin cuts back 7%. And I'm giving them just an 8 times multiple on operating income. These were the numbers from my past video. This is a scenario that I think is probably consistent with Ricardo and Raheem's view of the company. In fact, if either of you or anyone who agrees with this bearish view of Lululemon are watching this, let me know. Do you think that these numbers are consistent with your view of the future of this company? I want a bear scenario to be an extremely pessimistic view because I want to know what is my downside here. And to me, over 5 years, I don't think my downside is actually that huge with Lululemon. If my assumptions here come true, I am basically flat on my money on this stock for 5 years. And yes, that would mean the fair value today would be significantly less than where it's trading for. But I want to make sure as best as I can that I don't lose an absolutely massive amount of money when I am wrong about a stock. Obviously, there will always be things we can't predict. There will always be volatility. If you want to see more about Lululemon, you can find my recent video on my channel, but I think I will end it here. Hope you got value out of the video. If you did, subscribe to the channel, maybe give it a little like for the algorithm. And I know I say this one in every video, but I truly mean it. If you agree or disagree with anything I said, please let me know down in the comments below. I read the comments. I always try to reply to some of them. And with that, I hope to see you all in another video.